Welcome back to Investing Talk Podcast.
Today we're looking at stock.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of stock. For me, the narrative here isn't just about, incremental growth anymore.
Right.
It feels like it's about a complete re-rating of the stock. And it's based on these two really powerful forces.
Which are?
First, AI driving much deeper monetization. And second, AI simultaneously driving this unprecedented margin expansion.
It's an efficiency story that's kind of layered on top of what's already a very resilient growth engine.
Exactly. And the Q1 2025 numbers, they pretty much confirm this whole thesis is in full swing.
Okay, so what did we see?
Total revenue came in really strong at $5.18 billion. That's a 12% year-over-year increase.
Which beat consensus, right?
Beat it across the board. But here's the really key part. That growth isn't just from, finding new users. It's coming from getting more from the users they already have, all through AI adoption.
And the adoption rate for those new features is, well, it's kind of staggering.
It is. We're looking at 93% of Creative Cloud paying customers now actively using the AI-powered features.
93%. Wow.
Specifically, the Firefly integration. To, put that in perspective, that's almost every single professional designer in their ecosystem now relying on these tools.
And that reliance, that dependency, it translates directly into pricing power and retention.
It absolutely does. If we break down that revenue, Creative Cloud is still the workhorse. It grew 14% year over year to $2.83 billion.
So predictable, high-margin revenue.
Exactly. But we can't overlook Document Cloud. It includes Acrobat and Sign, and it showed a really impressive 13% year-over-year growth, hitting $1.02 billion.
And this isn't just people opening PDFs anymore?
No, not at all. This is deep enterprise adoption. Think PDF AI tools that can summarize documents, extract data, automate workflows for, legal and financial firms.
Okay, and what about Experience Cloud? That was always the laggard, wasn't it?
It was, but it seems to be recovering nicely. It posted 9% year-over-year growth, and crucially, it showed sequential acceleration.
So the big enterprise digital transformation projects, they're starting to unfreeze.
That's what it looks like. And stock is really the prime beneficiary. Now, if the revenue story is strong, the margin story is where the whole valuation really changes.
This is where AI stops being just a cool feature and becomes a structural advantage.
That's it. We saw operating margin expand to 38.7%. That's up from 37.1% the year before.
Wow, 1.5 points expansion at this scale. That's not small potatoes. That tells me the efficiency is hitting the bottom line way faster than analysts expected.
And it looks highly structural, meaning it's probably permanent.
Why is that?
Two huge non-recurring drivers. First, internal automation. They're using their own AI tech, and it led to an 11% reduction in G&A headcount.
So they're literally automating away their own overhead.
They are. And second, they finished this massive, years-long cloud infrastructure optimization, basically their migration to AWS.
And that move delivers real recurring savings. We think that alone is saving them something like $220 million a year.
It is. And that's not just a cost cut. Think about it. That recurring saving acts like a permanent boost to their R&D budget.
Yeah, that's a good point. That's $220 million they can outspend rivals with every single year without hurting profitability.
It's a structural advantage. It just widens the innovation gap.
Right.
And you can see management's confidence. They revised their 2025 non-GAAP EPS guidance upward. The new range is $15.70 to $15.90.
So the company is generating massive growing profits. But, in the software world, profit only matters if you can actually defend it.
True.
So let's talk about the moat, but first the balance sheet itself.
Okay. The balance sheet is what you'd call fortress strong. They've got $7.82 billion in cash and equivalents.
And it.
Almost nothing. The debt-to-equity ratio is just 0.19 times. This gives them huge flexibility for acquisitions or, any economic downturn.
The real star for me, though, has to be the free cash flow.
Absolutely. In Q1, FCF hit $1.75 billion. That's a massive 28% increase year over year.
Which gives them a record FCF margin, right?
A record 33.8% FCF margin. And to give that context, their FCF has grown at a 21% compound annual rate over the last 3 years. This level of cash generation is, frankly, the envy of the entire software sector.
And they're putting that cash to work. They bought back $675 million of their own shares in Q1.
Yep, reducing the float, which helps EPS. And they've got a 14-year streak of dividend increases going.
Okay, but a 33.8% FCF margin, that's huge. With that much cash, why spend so much on buybacks? Why not make I don't know, a larger strategic acquisition, say, to capture the generative video market sooner?
That's a fair challenge.
Hmm.
I think the repurchases provide immediate, predictable returns. They help stabilize the stock. But you're right, the strategic focus right now seems to be internal R&D acceleration.
Using that $220 million saving we just talked about.
Exactly. They're building, not buying, their Gen AI future. For now, anyway. Possibly because of prior regulatory headaches.
Let's pivot to that moat then. Why can't a competitor just copy them?
The first layer is the switching cost, and it is enormous. The average Creative Cloud user has been on the platform for almost 5 years.
Think about that. An enterprise designer with 5 years of muscle memory in Photoshop. It's not just migrating files, you're migrating an entire institution's memory.
And for an enterprise, moving those complex workflows, all the proprietary PSD layers, custom fonts, color profiles, it's a massive undertaking. It can easily cost a major company over $500,000 just to replicate their setup somewhere else.
And that estimate feels conservative. But the really unique layer of the moat is the IP and legal safety. Let's talk about Firefly again.
Right. So Firefly, their generative AI, it's trained specifically on assets they own or have commercial rights to. This is the cornerstone of their legal argument.
And that legal safety is a huge barrier to entry. If you're a big company, an ad agency, a car maker, a Hollywood studio, you simply cannot afford the risk of using Gen AI tools that might expose you to some catastrophic copyright lawsuit.
That's the key differentiator. Stock offers legally certified enterprise use. Rivals are currently facing legal challenges over their training data.
And then you layer on the network effects. Over 10 million businesses have their APIs integrated into core systems.
Yeah, whether it's Salesforce or SAP, their tools are baked into how these businesses run. Every new integration just deepens that lock-in.
And when you compare this to the competition, the differences are pretty stark.
Take Canva. It's
Yeah.
popular, sure, but it lacks the deep, granular tools for professionals.
Their user base is overwhelmingly non-professional, right? Something like 89%.
Exactly. They serve different masters. And Figma, while it's a fantastic tool for design collaboration,
It doesn't have the whole stack.
it doesn't. No native PDF, sign, or commerce. You can't do that big, enterprise-wide cross-sell that stock provides.
Okay, so if we connect this fundamental story to how the market sees it, the technicals look pretty bullish.
They do. We've seen the stock forming a classic bullish cup-and-handle pattern on the monthly charts. It suggests a multi-year consolidation is ending.
And it broke out above that key $645 resistance level.
Decisively.
Yeah.
And the momentum indicators are confirming the shift. We got the Golden Cross confirmation back in March.
That's the 50-day moving average crossing above the 200-day.
Yep. And that signaled to trend followers that the long-term selling pressure was over. It brought a whole new wave of institutional buyers in.
And the RSI, is it overbought?
Not yet. It's sitting at a neutral bullish level, so there's still plenty of runway.
This technical strength is also being echoed by analysts and institutions.
Yeah, we've seen a wave of upgrades. Morgan Stanley, Goldman Sachs. And what's crucial is why they upgraded. They all cited accelerating AI monetization, especially in the Experience Cloud.
And we have some very clear signs of insider conviction. The CFO made a big purchase in March.
A very significant purchase. 12,500 shares worth about $8.4 million.
And that was her first insider buy since 2020. When the person signing off on the financials puts that much of their own money in, that's a powerful signal.
It's the clearest signal you can get. And the institutional whales are piling in too. BlackRock, Vanguard, State Street, they collectively added 4.2 million shares in Q1 alone.
Okay, let's look forward. The catalyst calendar. What could move the needle here?
The dominant event on the horizon is the Q2 2025 earnings report that's scheduled for July 24th.
And consensus is looking for what, about $5 billion in revenue?
$5.06 billion revenue and 3.29 cents in EPS. But the number everyone is watching is operating margin.
Right. The whisper numbers are suggesting that if they hit 39.5% or higher,
that will be seen as a massively bullish confirmation that those cost savings are fully flowing through.
We also have the Adobe Summit in June. We're expecting a beta reveal of the Experience Cloud Gen AI platform.
And on the macro front, if we get those anticipated Fed rate cuts in Q3, that should act as a strong tailwind for enterprise SaaS spending.
Okay, we have to look at the bear case. What are the risks?
The top concern right now is regulatory scrutiny. There's some chatter about the DOJ potentially investigating the bundling of Creative Cloud products.
So Photoshop, Illustrator, and Firefly being sold together. They see that as anti-competitive.
Potentially. given their dominance.
Oh, so what's the real risk of a forced unbundling? If the DOJ makes them sell those things separately, does that erode their pricing power? Does it weaken the whole moat?
It's a serious risk because it targets the heart of their business model. Forced unbundling could lower the average revenue per user. But the counterargument is that the DOJ has a very high bar for this sort of thing.
And the products are so integrated, it would be hard to split them up.
Exactly. Especially with Firefly now woven into the core workflow. It's a risk, but it's not a slam dunk for regulators.
Okay, what's risk number two?
Competition at the low end. Pressure from cheaper rivals like Canva threatening their SMB funnel.
And if they lose that entry-level pipeline, their long-term growth could be damaged. How are they fighting back?
Their counter strategy is the Express Pro tier. They're converting SMBs to this new service. It's about $20 a month and includes the full suite of AI tools.
And is it working?
Retention rates in that specific tier are very high. It suggests once an SMB user gets a taste of Firefly, the switching cost reasserts itself, even at the low end.
We should probably touch on the speculative chatter, too. Unconfirmed noise, but interesting.
Sure. There are always rumors about potential large acquisitions. Notion is one name that comes up, or even another attempt at Figma.
And what about that generative video product?
Right. Project Loom, unverified reports suggest they're prioritizing it for a late 2025 launch to get a clear answer to companies like Runway.
So if you pull this all together,
I think the core investment case for stock is incredibly well supported. You have undeniable AI differentiation that's legally protected, you have high recurring revenue, and you have these powerful margin tailwinds from AI-driven cost cutting.
it's really positioned as the essential enterprise software play for legally defensible generative AI.
It is. They're leveraging it to redefine their own profitability.
If you enjoyed this analysis and want more deep dives into market movers, make sure you hit that subscribe button.